Hello everyone, and welcome to Simply Finance. 2 years ago, the investing community lost a hero when John Bogle died at the age of 89. Most investors aren't familiar with his name, yet he's the creator of Vanguard, a well-known financial services firm famed for its low rates. As a genius in the financial world, we will be taking a look at the top financial strategies from him. Here's a short backstory on John Bogle. Bogle earned his bachelor's degree in economics from Princeton University, where he focused on mutual funds. He began his career at Wellington Management before creating Vanguard Group, a mutual fund business, in 1975. John revolutionized the mutual fund industry by inventing index investing, which allows investors to purchase mutual funds that follow the wider market. His goal was to make investing easier and more affordable for the typical investor. Bogle used a unique ownership structure with Vanguard, in which mutual fund shareholders were part owners of the funds in which they invested. The investment firm is owned by the funds, rendering fund investors indirect shareholders of the company. This structure allows the company to reinvest any earnings back into the business, lowering investment costs for fund participants. Bogle launched the Vanguard 500 fund in 1976, which follows the S&P 500 and was the first index fund sold to individual investors. Vanguard's unique structure makes it a perfect fit for the offering of no-load mutual funds, which do not charge a commission on investment transactions. In 1976, when the Vanguard 500 fund was initially created, it barely received $11 million in its first underwriting. The fund currently manages $739 billion as of June 2021. Later in 1999, Bogle stepped down as CEO and chairman of Vanguard and published a book called Common Sense on Mutual Funds, New Imperatives for the Intelligent Investor, which has since become a standard for investors throughout the world. Now on to John Bogle's passive investing strategy. He was a big part of the rise of index investing, which is when a fund has a mix of investments that reflect a market index. Bogle's belief that typical investors would find it difficult or impossible to outperform the market over time prompted him to emphasize measures to minimize mutual fund fees. Bogle, for example, concentrated on no-load funds with low turnover and straightforward investing methods. The theory behind passive investing is that the costs of pursuing high market returns cancel out most, if not all, of the profits that an investor would otherwise make using a passive approach that focuses on funds with lower turnover, management fees, and expense ratios. Active investing, on the other hand, requires managers to take on a more hands-on approach with the goal of outperforming the market. Because index funds base their holdings on the stocks included on any particular index, they suit this paradigm perfectly. Investors who buy index fund shares get access to the diversification represented by all of the securities in the index. This guards against the possibility that a single firm may detract from the entire fund's success. Index funds are also self-managing, with managers simply having to verify that their holdings match those of the index they track. Finally, index funds provide higher tax-efficient returns than other types of funds because they require fewer trades to maintain their portfolios than funds with more active management methods. Here's more investing advice. Can't imagine a 20% loss in the market? Then don't be in stocks. This has been amply demonstrated by the recent stock market meltdown of 2020. If you're going to invest in stocks, you should be aware that the market dips by 20% or more every few years, and that the market has always recovered and gone on to new highs following each collapse. This can happen in as little as a few months, but it can also take years. That's why you should only invest in stocks with funds that you won't need for at least 5 and preferably more years. The true investor will do better if they pay attention to the operations of the company. To put it another way, be a long-term follower of fundamental investing, which entails keeping track of the businesses in which you own shares and evaluating factors such as market share, profit margins, track record of growth, opportunities for further growth, sustainable competitive advantages, debt and cash levels, and so on. Jumping in and out of equities without a strong grasp of the underlying company and reviewing how the stock market and your assets are performing every day or even every few hours is the polar opposite of this. Another tip is don't buy funds based on past performance. This is a typical error made by mutual fund investors as well as stock investors. If you find a mutual fund that has increased in value by more than 50% in the past year, you may decide to invest, hoping to earn a 50% return on your investment. That isn't how it works though. Any fund or company can have a fantastic year thanks to investor enthusiasm and optimism or a genuinely outstanding performance. However, this does not occur every year. When equities and mutual funds get ahead of themselves, they have a good chance of reverting to more realistic levels. Focus on long-term outcomes and place greater emphasis on what you expect the firm or fund to achieve in the future rather than what it has done before. Lower costs are the handmaiden of higher returns. It's undervalued how vital it is to choose low-fee mutual funds and other assets. Here's an illustration. Consider 3 different equity mutual funds. The first is an index fund with an annual cost of 0.10%, while the other 2 have annual fees of 1% and 1.5%. If the stock market grows at a 10% annual rate over a particular time period, those funds will have average annual gains of 9.9%, 9%, and 8.5% respectively. And that's it for today. If you enjoyed, make sure to like, subscribe, and hit the bell for more videos.